Yeah, we are glass half full. A few reasons for that. Maybe if we take a step back, in July we moved our portfolios to neutral equities. So we were overweight equities, we went overweight in April. In July we thought let's take some profits. And the reason that we're optimistic is some of those risks that we saw in July we think will be out of the way by Christmas, January next year. What were those risks? Firstly, the US presidential election. We'll know the result of that on the 4th of November. Secondly, the Chinese-US trade dispute. That seems to be working its way through the system and is not getting paid much attention. The third thing is that the lockdowns associated with the second wave, we expect they won't be as aggressive as they were in the first wave, and so the negative impact on the global economy will be much less. And then fourthly, we do think, our global pharmaceutical team does think that we'll have some good news on the vaccine front from one of the big 4 phase 3 tests that are going on right now. So for those reasons, beyond Christmas, we're optimistic, and we think that assuming governments and central banks continue their massive stimulus and support programs, which we think they will, and we think if they need to do more, they will, then we'll get a pickup in the global economy early next year from a reasonable sort of base already, and that should be good for stock markets. The obvious one is the power of a multi-asset class portfolio. So when the COVID sell-off happened, at first everything was getting sold off like happened in the GFC. Bonds, equities, commodities, everything. And then after it only took a few days, the market realised that, hang on, no, bonds remain a space of, or a place of safety. So then we had bonds picking up, prices picking up, bond prices picking up and yields falling. And we had central banks taking a very vocal, we'll do whatever it takes to protect markets. So bonds started popping, and that was great for multi-asset class portfolios. The other thing that happened is that the Aussie dollar weakened dramatically. So our starting point for international exposure is unhedged, and that's because of the pro-cyclical nature of the Aussie dollar. So what that means very simply is when markets are crashing, the Aussie dollar weakens significantly because it's seen as a growth, a growth currency, that it's a currency that's directly related to the growth in GDP around the world. And that protected portfolio. So international equities, sure, in local currency were falling, but in Aussie dollar terms, we're actually holding their levels. So that was a good buffer. And also, in general, alternatives did their job. So reasonably uncorrelated with listed markets. So hedge funds and commodities, did reasonably well in Aussie dollars, but less so for the commodities.